Let us continue with investing. First, I would like to thank all of my viewers for your patience. I know I've laid a lot of foundational background as far as investing and the behaviors of investing. So again, I appreciate your viewership and your patience. First, I'd like to explain my presentation layout very briefly. So what I have included here is a clock, which represents time, of course, meaning time in the market, time in compounding, and time for you to then enjoy your lives and your fruits of your labor. Here, obviously, are some dollars, not necessarily intended to represent cash, but to represent the concept of financial freedom. As you can see also here, I have droplets of water and larger droplets, basically symbolizing that small droplets become big droplets. Again, on the same concept as far as growth is concerned for compounding of your investments and growth for you personally as well. Just want to start off with a side note, advantages of a living trust. This particular topic was presented to me, was a comment from one of my viewers, so I just wanted to very briefly touch on this particular subject. So there are three key advantages to a living trust. To avoid probate. Probate is basically the process of distribution of your estate, of the assets of your estate. If you don't have a living trust, then your estate will go through probate, which is a very lengthy process and very costly. Living trust also protects your privacy. If you don't have a trust and it goes through probate, all of the information regarding your estate is public information. The last item is a living trust spells out a very clear plan of distribution of the assets of your estate. There will be no confusion as to who gets what in your living trust. Should you save money in a bank? Yes or no? The answer is yes and no. For emergency purposes, it makes sense to have money in a bank account. It's easy to access, very liquid, obviously. So for that purpose, for emergency purposes, the answer would be yes. For investment purposes, the answer is no. You basically earn very little in interest in a traditional bank account, traditional savings account. So generally speaking, for investment purposes, the answer would be no. There are other videos that express how much to save in a bank account, whether it be 3 months of your expenses, 6 months of your expenses. So there are other videos that touch on that specific topic. It is finally time to get to the main topic, which is investing. Again, thank you all for your patience, and let's get started. There are multiple types of investments. Just want to mention a few of them, which are the key ones. Start with CDs. Okay, CDs does not stand for compact discs. It does, but not in regards to investments. Those are certificates of deposits. Bonds, another type of investment. Stocks, which is shares of stock of companies. Mutual funds, ETFs, and options, which are groups of stocks and other types of investments that are stock related, can be stock related. Real estate, obviously, is property. Cryptocurrency and NFTs. NFTs stand for non-fungible tokens. wanted to just very briefly mention those as investment options. So getting into each of these a bit more. Again, CDs from the investment standpoint does not stand for compact disc. The interest that's earned on CDs actually isn't too bad. You can get 4%, maybe even slightly higher, depending upon the CD. The benefit of CDs is they are FDIC insured. One thing to keep in mind is that as far as FDIC insurance is concerned, it's insured up to $250,000 per bank. Bonds, what I'm referring to there is primarily treasury bonds. Those are also a very safe type of investment, similar in nature as far as the interest rates that bonds are currently offering. Some are again in the neighborhood of 4%. You also do get some tax benefit for treasury bonds as well. Stocks or equities or shares of a company. There are thousands of different stocks. They can be categorized in a number of ways, so I will just briefly touch on a few of those categories. There are growth stocks, which are basically stocks that have high potential. There are dividend stocks, which are generally mature companies that essentially pay you a dividend for owning those shares of stock in those companies. Blue chip stocks are generally large companies, generally also mature. And on the other end of that spectrum, we have what's called penny stocks, which aren't necessarily pennies per share, but generally stocks that are under $5 per share are generally in the penny stock category. The other options, such as mutual funds and ETFs, those are generally groups of stock that make up a particular mutual fund or ETF. An ETF stands for Exchange Traded Fund. So essentially those are groups of stocks of different companies that make up either a mutual fund or an ETF. The basic difference between mutual fund and ETF is an ETF behaves more like stock in that it is traded regularly throughout the day, so the price of an ETF will fluctuate during the day as compared to a mutual fund where that price is set at the end of each business day. Stock options are basically contracts for you to buy and or sell a particular stock at a certain time with a certain expiration date. Not going to get too much into that as I am looking more towards investing in stock as we proceed with the presentation and future presentations. Real estate meaning property. Okay, very good investment. However, it requires a large capital investment. Rental property, which then generates passive income, is obviously a very good investment. Essentially, you then become a landlord if you like being a landlord. How aggressive or conservative should you be? Very good question. There is a simple calculation to gauge how aggressive or conservative you should be. You take the number 100 minus your age, and that will give you what percentage you should be in stock or essentially to be in the aggressive category. For example, if you are 60 years old, you would take the number 100 minus 60, which equals 40, which would be 40% you would want in stock or aggressive investments, and 60% conservative. A few years ago, just to give you a little context, I was about 80% aggressive and 20% conservative. After I turned the age of 60, I made some adjustments, and so currently I'm about 60% aggressive, 40% conservative. To give you a little bit more information, my brother and sister-in-law, they are very aggressive investors. My brother's a little bit younger than me, and they are about 90% aggressive and 10% conservative. Okay? Very aggressive investors. Some analysts like to use 110 instead of 100. There are other videos that have different opinions on this. So just want to mention it to you. For me, I use the 100 calculation. How much should you have in savings and investments? Very good question. So another viewer had mentioned the rule of 72, and I want to briefly touch on that. So the rule of 72, basically it's a mathematical equation that results in the concept of taking the number 72 divided by the expected rate of return that you anticipate or would like, and that will give you the number of years for your investment to double. So simple example, if you take 72 and you expect a 10% annual rate of return, it would take you 7.2 years for your money to double. How much, again, should you have in savings and investment? Looking at this in a different manner. So at the age of 30, you should have 1 times your salary. Again, this is just a general gauge. At the age of 40, you should have approximately 3 times your salary. At the age of 50, you should have 6 times your salary. And at the age of 60, you should have 10 times your salary. Now keep in mind, this is just a gauge to maintain your current lifestyle. There are a number of variables that can sway those particular numbers. Again, that is just a gauge. Okay, let's achieve financial freedom. That is the ultimate goal. And let's have a fulfilling and enjoyable life. Thank you all once again. Greatly appreciate your viewership. And we'll move on to the next section. Thanks again.